Hi guys, I'm AP. In this video, we are going to see the chapter 13 in the book The Intelligent Investor. The chapter 13 is a comparison of the four listed companies. But in the video, we are not going to see what Graham mentioned in the book because the four stocks are traded in the New York Stock Exchange. We cannot relate ourselves with the stock. So, in this video, we are going to see what are the parameters we should consider while comparing and evaluating a stocks. Okay, let's get started. Ram says, first things first, we should consider studying the annual report for the company for the past 5 years, which are all the stocks we are going to compare. We should always know top to bottom of the company, what the company are doing from the starting till now. Before knowing a company top to bottom, we cannot consider comparing the stock with the other stocks. So first thing is we should study the annual report of the company top to bottom. Okay. Second one is if we are going to compare a stock with another stock, then it should be in the same industry category. Let me give you an example. If we are going to compare an IT company, then we should select a opposite company also to be an IT industry background company. It is because so that only we can relate and compare all the parameters from their business and where they are locating and for whom they are serving from top to bottom. The thing is, we should consider comparing the company with same industries. Okay. Program main takeaway one should consider before investing in a company is the price to earnings ratio. We discussed that in our past videos. Now let me explain for you in a simple way. In what price we are paying to buy a share of the company, and for that price what company is producing value to us, that is the earnings to us. It is the price to earnings ratio. It's a simple but it's an effective way. We should always consider looking at this parameter at least once before investing in a company. Okay, now Graham says there are six main criteria one should look when comparing the companies inside the industries. The six main criteria are: first one profitability, second one stability, third one financial position, fourth one is growth, fifth one is dividend, and sixth one is price history. Now let us see that in an elaborate way. The first one is the profitability of a company. How can anyone miss to see how the company is making profit? It is always the earnings of the company. If the earnings is growing steadily in an year on year, then the annualized stock growth is also in a similar way. Graham says a high rate of return on investment capital goes along with the higher annual growth rate in earnings per share. One should always look at the profitability of a company and steady growth in the profit of the company. Okay, the second one is the stability. The company should be steadily making profit over a period of time. It is what Graham says. The company should not show 1 year high profit and another year low profit and another year followed on by high profit. It is not a good sign. The company should show in profitability in a long run so that it is a very good investment for an investor. The third one is financial position. Financial position is nothing but how the company is handling their debt. If the company has more debt, then it is a bad sign according to Graham. Okay, the fourth one is growth. The company should show a steady growth in their earnings and their profitability. If a company is earning, let's say 5 crore this year, then it should show at least a 5% of earnings in the next year and follow up on the next year. The growth of the company is a very important thing. Even though we are finding a common stock, and it should be, and the price will move upon the price will move higher if the stock grows by its earnings. A steady growth for a company is very important while we are selecting for an investment purpose. The fifth one is dividend. If the company really makes profit, and it should distribute some of the profits to their shareholders to make them happy. Graham says there are another exception situation in the in which the company can reinvest their dividend in further acquisition or building a new plant. In that case, it is an negligible one. Investor can bear with the dividends. But Graham always advises dividend with a company which delivering a higher dividend is a good for investment. The sixth one is price history. The price fluctuation for the stock should be not more higher. The price of the company should be in a smooth and steady way so that it's a good for an investment. Okay. Let me conclude this chapter by saying that for comparison of the stock, first one Graham says is the profitability of the company, and for that profit, how much we are paying for that. Let me repeat this statement another time. It's nothing but the price what you pay and value is what you get. Even though it's a high profit making company, at what price we are buying is will decide our profit in their long run. So even though the company is making very good fantastic profit, we should not consider buying that company at a very costly rate. We should wait and consider buying that company at an correct valuation price so that in the long run we can make profit out of it. While comparing stocks, these are the 6 things we should consider while comparing the stocks according to Graham. Okay, in the next chapter we are going to see the stock selection for the defensive investor. Stay tuned. Thank you.